Hi all. One of the points in the finance bill which has been where the press has been going gung ho and many industrialists have all appreciated is about the angel tax or 5627B getting abolished with effect from assessment year 25-26 onwards. Now, those readers have not probably seen the fine print of the legislation. Couple of budgets before, Section 68 was expanded in its scope, and alongside Section 68 we had Section 5627B, where if something could not be caught under Section 68, it could fall within the realm of Section 5627B. Now, just to give you a checkered history about 5627B, out of the innumerable number of decisions which are there in 5627B, I do not come across even one decision where the revenue has been able to fasten a tax on an entity, on a closely held company which has issued shares or has received a consideration more than the fair value of the shares as computed under 11 UA or under the relevant income tax rules. It has to be remembered also that recently the 11 UA rules were also amended, aligning it with the market position or more so on valuation principles. Now, there is parallel to this Section 50CA under the law, where in the case of a closely held company, if the transfer is not at fair market value, the assessing officer can call upon the fair market value under the same 11 UA rules. So is the case of Section 50D also existing in the statute, where again the fair market value will be called upon, especially where the consideration is indeterminable or cannot be deciphered. In all these cases, there is going to be a fallback on the valuation principles under 11 UA. Now, under 5627B, the hands of the assessing officer was tied. Either he was supposed to follow the net asset value method or the discounted cash flow method, and there were decisions which went on to hold that subsequent performance of the entity based on the erstwhile discounted cash flow estimations, etc., cannot be used to make disallowances. In short, the purpose of Section 5627B had outlived its purpose. Now, for a minute, step aside, go over the fine prints of the Finance Bill 2024. Specified domestic transactions are again brought into the realm of Section 92CA. There was a small period where specified domestic transactions were kept outside the law, and again now it is again being brought into picture under transfer pricing provision. Now, under transfer pricing provision, even capital transactions are brought into the realm of transfer pricing, arm's length benchmarking, recharacterization of loans into equity are all being done already at a non-resident versus a resident level under transfer pricing. So the point I am trying to stitch together is with Section 60A, with Section 50CA and with 50D, read with the transfer pricing provisions and the GAR and the SAR rules, there is enough machinery besides 56 to 10, where in the hands of the investor it can be the excess price over the fair market value can be treated as an unexplained investment as well, and can be brought into income from other sources under that particular section. So there is enough ammunition and machinery with the revenue to tackle the case of angel tax already in the statute. Simply said, it appears to be a hogwash by removing 56 to 7B. I'm sure people will have a contrary view on this, but if we read the fine print and put together the various jigsaws of the sections that I have mentioned, 68, 56 to 10, 50CA, 50D, and then transfer pricing provision, GAR, SAR, I'm sure we will all understand that the removal of 56 to 7B is just an eyewash. So the devil is always in the details. We will meet once again. Thank you.